Hello, ladies and gentlemen. You're welcome to DBA 104. This is a virtual session for DBA 104. And we're going to be dealing with raising capital for financing your business and the pitching tips. I will be taking you on this class. It's a three-part series. My name is Peter Ogbonna, and I think you can just look through my profile. It's a three-part series. We have decided to make this a virtual class because of the brevity of time we have on Saturday. To take this class, because we want to do more practical sessions with regards to pitching. And so we want you to get all the theoretical presentation sessions online, stream the video or download the videos and watch, and just be ready for what's going to happen at this live session tomorrow. Okay. I'm going to be running through the raising capital, sources of capital section of the presentation, but we'll be specifying, spending more time with the pitching. So please stay with me. So like I said, we have the DBA 104A. We are dealing with primary financing for your business. 104B, sources of capital and financing for SMEs. Almost pretty much some related stuffs. And then 104C will be dealing with pitching. All right. Now, to start with, businesses usually are financed in one of three ways. First is self-financed. You start with your own money. If you remember the book written by the senior pastor of Daystar Christian Center, start with what you have. The first and the most reliable place to raise money for your business is from your own money. So the question is, how much do you have on your own? That throws a lot of revealing question or probes your financial management skills. The second part is debt financing. You can finance your business through debt, which is borrowed money. And the third part is equity finance, where you take on someone who acquires a partial interest in the business in exchange for money. We're going to be looking at that in more details. There are other possible sources of capital for startup businesses, especially in Nigeria. Like I said, personal savings, which is your own money, is the most important part of it. Also, you can get loans from family and friends. You know that. These are simple, easy ways to get financing for your business. Of course, you can get debt financing, like I said earlier on, and you can borrow on life insurance or home equity. You can actually turn your equity into funds for business. Like, there are a lot of life insurance policies that can also allow you borrow for, especially if it's a business, something that would bring back the returns. So it's a life insurance, but you can draw from it, do your business, and then return the money back. So that option exists. There are also angel investors, which basically are wealthy people, families, or entrepreneurs who are just bringing in their money to allow it accumulate some profit, and they just cash out. Now, this is very important because the states where we are getting into Nigeria in our environment is where a lot of angel investors, venture capitalists will play key roles in the activities of startups. So it's necessary that you know how this works. We'll be dealing with that at the pitching section. Of course, private placements, we call it private placement memoranda, which is a group of angels that you assemble privately and say, okay, you know what, I'm giving you a stake, but the difference is that you're not placing it public. You just handpick people that you say, you know what, I want you guys to be shareholders, but it's based on special interests, right? You can also use cooperative loan programs, which are, there are different cooperative programs around. All you just need to do is investigate the one that is ongoing in your community, or even in the place where you work. A lot of organizations have cooperatives. You can access that. Large-scale commercial loans exist with commercial banks. Of course, you will need a track record, good accounting system, good loan proposal, a banking relationship. Of the first and most important thing is that you must have a bank account that you've operated faithfully over a period of time, and some bit of collateral or something that the bank can hold on to. So you need to get to know your banker. And bring in a well-packaged business plan. And we've talked about that. You know, the essence of module 1 has been to help you produce a bankable business plan. All right, questions to ask when seeking debt capital. Commercial or microfinance banks will ask these questions every time you approach them to seek debt capital. You know, debt capital, you're asking somebody to bring in money as a debt, meaning you are going to pay them back. For equity, you are not paying them back. You give them a stake in the business. When you approach Bank of Industry, any microfinance bank or any commercial bank, there are some questions that they ask. Number 1, how large a loan do you need? What's the volume of loan you need? How will you use this money? And these are all the things that you need to put into consideration when packaging your loan proposal. Why this type of capital? Why does it benefit your business? Why would you come for a microfinance capital that has this huge interest on it rather than going for commercial? Or why would you come for commercial rather than going for microfinance loan? All these are questions that they are asking. The next thing they want to know is when can you pay back, and how will you pay it back? Okay, what are your instrumental payment arrangements? Why are you and your company a good credit risk? Credit rating in Nigeria is not yet institutionalized, but if you go outside the country, every company has a credit rating. We are going to start it very soon in Nigeria. Credit rating is just about how faithful are you with paying your debt. Okay, who owes you, who do you owe, and how do you do your debt management? It's a system. It's working very well over there. We have not yet developed it, but I bet you it's going to come up very soon. What if the business fails, or you can't repay the loan? They want to see it in your proposal. The other thing they want to see is, are you growing too fast or in a manner that would jeopardize your ability to repay? Sometimes when it starts too quickly, it's likely to fail. It's likely. It's not a guarantee, but it's likely to fail. So they are looking at all of that. The rate at which you're growing, are we sure that we're not going to get into trouble with our money? Okay. Like we said, microfinance loans are also very common, but the truth is it requires collateral and may come at higher interest rates. Venture capitalists also exist. It's not an easy option for small businesses just starting out, because venture capitalists invest in high growth promising industries. They want their money back. They are venture capitalists. They are capitalists. They're coming in for the business. They want to see what gives them the highest and greatest returns. Okay, all venture investors ask this kind of questions. Okay, these are the questions they ask entrepreneurs. 1, how much can I make? So if you're talking to a venture capitalist, you need to first give him that answer of, this is what you're going to make. How much can I lose? They're not fools. They understand the business terrain. They know that things go wrong. So when you pitch to a venture capitalist and you give the impression that everything will go on very well, they already know that you don't understand your game. So they want to know, 1, how can I make my money? Number 2, how much can I lose? How much can I lose? And if I'm losing, what's my exit strategy from this deal? All right. Number 4, who else says this deal is viable? They want to know the people who have given credibility to this your fantastic idea. Number 5, does the founder, meaning you and others, already have resources at risk? Remember I said, when you're approaching an organization, an individual, an investor to bring in money into your business, they want to know, what do you have at risk? How much of your money, how much of your resources, how much of your assets have you put at risk to run this business? Okay. Number 6, what other value beyond money can I bring to the table? Okay, that's the question they ask when you're standing and making your pitch before them. Number 7, can I trust this management team? It's important you put credible people on your management team. When you run an IT business and on your management team there is no single person who has an IT certification, who has an IT background. It raises doubts in the heart and the mind of your venture capital. So you need to put that into consideration. Is this company's target market large or growing? Is it not stagnant or shrinking? And is it reachable? Is it a reachable market? So when you are doing your market market analysis, your market opportunity, the venture capitalist is sitting down there and is watching what size of market are you targeting. Are you targeting a household? Are you targeting a street, a state, a city, a nation? Are you targeting the entire world? They know when you are making realistic projection, and they know when you are being unrealistic. So you need to watch that. Does the company have, or will it have, a sustainable advantage as a result of either operational effectiveness or its strategic positioning? Will the way you operate give you a sustainable advantage? Will the positioning you have in the market give you strategic sustainable advantage? Don't forget that they are investing to ensure their money come back. They are investing for the long haul, because sometimes they pull their investment out, they pull their profit, and they bring it back again to make more profit. So they want to see whether you have that sustainable advantage. The 10th question: is the company's business, revenue and profit model credible, viable, efficient, and sustainable? Your profit model or your business model is very important to the investor. He wants to know, how do you make money? Listen, you can speak all the grammar, you can look all the best. If you can't convince the venture capitalist or the investor how this business makes money, and how credible it is, how viable it is, how efficient, and how sustainable. He wants to see your cash to cash cycle. He wants to see how long does it take you to make money. Does it take you do you have a 30-day cash cycle? Is your business the one that, listen, venture capitalist any investor will be interested in a business that brings in daily cash flow. You need to watch that. The closer your cash to cash cycle, the more realistic or the more interesting that your business proposition looks. Of course, there are some that you can't help. You supply and then they bring in payment after 30-45 days, but you need to show the investor within this gap, what are you going to be doing to ensure that you cover your overhead. Is very important. You can also stagger it and have a mix of many sources of financing for your startup business. If you look at the left side, you can see this man has personal savings, 60% of his personal savings there. He's not considering any bank loan. He's probably thinking 20% family, 12% employee, other employees and partners, 8% from friends. He's not thinking of venture capital, any venture capital. He's not even thinking of any other source. This is a model by someone. Someone else says, you know what, I'll do 45.5% of my personal savings, meaning I'll ensure I have 45.5% of the money I need. I'll get 35% from bank loan, 14% from family, 5% from friends, and ignore the others. The other guy says 35% from my personal savings, ignore bank, 12.5% from family, 12.5% from my fellow employees and partners, 10% from friends, 25% from venture capital, and the 5% from other sources. The allocation of your sources depends on one, the nature of your business, and then the condition of the source of the income, of the capital. So you need to bear that in mind. What do bankers really think when evaluating your loan proposal after you've submitted it and they are looking at it? What are they looking at? What comes into their discussion? Number one, have you shown sound business judgment in the past? Have you always had a written plan with timeline for specific business goals, accompanied by backup contingency plan? You see, when you make a proposition to the bank, they are not looking at what your projections alone. They are looking at your history. They want to see your records. They want to see the plan, how you've run this business. So what have you made sound business judgment? So they want to see the decisions you took in the past and the outcomes, right? The second thing they want to know is, do you see your banker only when you are in tight spot and need immediate help? What this shows them is that you lack planning. Do you have a relationship with your bank manager? Do you talk to them about your business even when you don't need them? It gives them a sign that you are a planner. You can begin to engage your banker. This is May 2015. You can begin to engage your banker in 2015 about a loan you want to get June 2016. It shows him that you are a planner, that you have your life and your business planned out. The other point is, do you inform the banker monthly of good news and bad, including steps taken to mitigate the effects of bad news? Are you carrying your banker along in what is happening in your business? You see, when you run to the banker, your bank manager, anytime you need loan, they already know, man, this guy is a fire brigade client. Okay. The other thing they want to know is, do you show your banker you have proper financial controls in place? What are the financial controls? How many people sign your check? What's your requisition system? What's your interest management process? They want to look at it. Do you discuss suppliers, pricing strategies, marketing plans, and sales results? All of these things are important discussions they have when they are at the loan discussion committee. Do you send customer mailings and samples of new products to your banker? Don't forget, your banker, especially if your capital sourcing allocation favors bank getting a loan from the bank, you need to ensure that months down the line, or even a year or years before you need the loan, that you are carrying, they already have a history of what you're doing. Is very important. Okay. Do you have a strong 5-year strategic plan for your business? And is this thing updated on a timely manner and shared with your banker? Are you maintaining a strong growth plan for your business, including its involvement in community projects? Have you considered co-sponsoring community courses with your financial institution? You see, the banks are looking at how responsible you are to your society. They want to see what you are doing for the society. They want to see initiatives, courses that you are championing, and you are also trying to carry them along. Even long ahead, you need a loan. Have you invited your bank to visit your business? Do you even arrange for him or her to meet your employees? These things are important. Sometimes you can just invite the bank manager. Just come and look at my factory. Come and see my office. Just come and see what's happening. Meet my CFO. Meet my HR person. These things are mind things. They are telling them that, oh, this guy is transparent, is very honest, and he is organized. Okay. All right. They want to know whether you invite inputs from your banker as part of your future planning activities. And they also know whether you are actively addressing safety and environmental concerns within your business, especially if your business has a health and safety implication. Okay. Are you seen as a strong community leader? And are you willing to provide guarantee as a reflection of your character and commitment? Okay. If nobody is willing to sign guarantee for you or warranty for you, it's already a sign that this guy or this lady may not be trusted. Okay. So everything you do, including your role as a community leader, it matters in when it comes to, like, you see this point. Are you seen as a strong community leader? So what you do, whether you are volunteering somewhere, matters. Because when the community talks good about you, the banker, it reinforces their confidence about you. Okay, so let's look at loan proposals. Loan proposals, when you make a loan proposal to the bank, most lenders will want the following fundamental questions answered. Who are you? How much capital do you need and when? How will the capital be allocated and for what specific purposes? How will you service your debts, obligations? Which is application and processing fees, interest, capitals, and some balloon payments. What protection or collateral can you provide and the bank in the event that you are unable to meet your obligations? What are your key business matrices and how well do you measure, monitor, and understand them? So you've got to prepare your diagnostic dashboard and say, these are the matrices. This is how I measure my sales. This is how I measure my customer acquisition. This is how I monitor them. How you measure, how you monitor, and how you understand them must be shown in the loan proposal. These questions are all designed to help the loan officer assess the risk factors in the proposed transactions. They are also designed to provide the loan officer and the information with the information necessary to persuade the loan committee to approve the transaction. So you must understand that the loan officer will serve as an advocate on your behalf in presenting the proposal to the bank's loan committee and shepherding it through the bank's internal processes. So providing the necessary information will make the job of the loan officer easier and in your interest. Why do loan applications find their way into the waste trash can? Why are they rejected? Number one, unrealistic low expense forecast. When you project your income so high and downplay on your expense, they think that you are not being realistic. Lack of a completed loan proposals. Inability to take constructive criticism, because when you come to a loan defense committee, they are going to criticize you. So if you're not able to take it, you're already turning them off. Underestimated capital requirement. You don't say you need 20,000 when they know that, man, this business, the least you can use to do this is 80,000. They already know that you're looking for money to run away with. Okay. Little or no experience in the business field. Remember the first class we took in DBA 101. Knowledge is the most important thing, not capital. So you've got to display that you understand this business. Overstating your revenue projections. Don't start making bogus promises. I'm going to make 20 million the first year. How are you going to make 20 million the first year? You are not. It's not a market you're just entering in. People are already playing in that market, so you've got to be careful in the way you make your projections. Attempts to play one lender against another. Sometimes these people have a way they meet. You don't want Bank of Industry to know that you are also talking to another microfinance bank and you are asking for the same loan and you are proposing the same collateral. So you've got to be very objective. You've got to be very very forthright in your claim. A lack of adequate collateral, like we said before. Poor communication skills. Communication, we're going to talk about pitching. Communication is very important. You've got to go and brush it up. Work on your communication skill, your presentation skill. Cash flow projections that do not demonstrate an ability to repay the loan. Your cash flow is just the way money moves in and moves out. So it must show that in the moving in and moving out, there's enough remaining to pay your loans. Cash flow projections without adequate supporting documentation and lack of understanding of the loan proposer and the approval process. Listen, if you have all of these things submitted, it's no guarantee that your loan proposal is going to be approved. There's a process to go to the loan committee. They are just in different places that you to enter to ensure that the bank is not exposing themselves too badly. Or at the end of the first session.